Hey, this is Hutch with BankingTruths.com, and today we're going to look at the top whole life policies for infinite banking in 2025. And we have a very data-driven case study. We're going to look at high early cash value. We're going to look at long-term cash value. We're going to look at all the top companies. And before we do, I just want to address some nonsense I keep hearing out there that some of my clients are saying that other agents they've talked to say, you know what, the policy, the company you choose doesn't really matter, and the policy details, they don't really matter as long as you're practicing the philosophy. It's all about the philosophy. And in what universe could this be true? Could performance not matter for a multi-decade compounding vehicle? And it does. So if you're hearing this, this is a major red flag. You're probably only seeing numbers from one company out there, and it's usually to mask the fact that the agents are selling lackluster performing policies at the expense of you. And so again, this is a major red flag. And so I would encourage you to make sure that you are seeing numbers from multiple companies. And if you don't understand the underlying drivers, you can download our free starter guide to understanding whole life for IBC at bankingtruths.com/starter. And it's a handy dandy guide that really simplifies things so you understand some of the context of what you're looking at. So without further ado, let's jump into our case study. All right, so let me go ahead and set up the scenario. In this race, we're going to compare the race cars of Penn Mutual, Lafayette Life, Mass Mutual, Guardian Life, and New York Life. All five of them to see who's ahead early, who's ahead late, who's ahead in the death benefit race, who's behind. And to do so, we're going to run everybody at the second best rating. That's preferred non-tobacco, not preferred plus, not standard, right in the middle. And if your rating goes up or down one, it's not really going to change the numbers all that much. Also, we're doing $50,000 of annual premium. People usually get hung up like, oh my gosh, this is only for rich people. I can't afford this. Listen, if all you can do is $10,000 of annual premium, just divide by 5. 50,000 of premium divided by 5 is 10. Divide the cash value numbers you see by 5. Divide the death benefit numbers you see by 5. Again, if you want to do 150,000, think of this $50,000 unit as just that, a unit. Multiply by 3. I think you get it. And lastly, we are stopping premiums at the end of the 7th year. So you can see the cumulative premiums go from 50 down to 350 and then they stop. That's only because just to compare, just to have a baseline comparing the overall efficiency of the policy. With all these policies, you can pay for longer. If you have the capacity to, you should pay for longer. But just to kind of set up an equal playing field, that's what we're doing. You'll notice that there's a lot of bold in the analysis, and all that means is that's who's winning in the race at that time. If I jump between 37 to 47, you'll see the same pattern kind of exists, and same with 57. There's a few little anomalies, but for the most part, what we see is that Lafayette Life has the strongest early cash value. So when the race cars right out of the gates, they're winning. And in the long haul, Penn Mutual seems to be winning at a pretty good clip across the board from not only cash value, but also death benefit. And same when we look at age 47, and same when we look at age 57. So I get that it can be somewhat overwhelming looking at all these columns of numbers. However, what I can tell you is when clients come to us and they already have policies, lackluster policies they got from another agent, the devil was in the details from the very start. They just didn't know what to look for. They heard good philosophy, they heard good stories, and I realized not all of you are ready to talk to a human yet, and that's why we made our free milestones report. You can get it at bankingtruths.com/milestones, and what it does is it educates you about those key milestones, those key stages that any whole life policy has when it's designed for IBC. Doesn't matter what company, doesn't matter how old you are, but this will help you be better informed so that when you're seeing numbers, you know what to look for. Now, if I just go back to age 37 and we go back to the high early cash value, a lot of people just stop and end there because really I think it's a place that they're going from something that's known, like I have my money in a savings account, and if I'm going to put it from this place that's in a savings account to this thing that's kind of foreign and new to me, I want to see most of it there. And so the more of it that's gone, the less comfortable I feel. But what you can see is that they're really costing themselves, and you'll hear me say this in a lot of my other videos, there's no deals in insurance. everything's priced perfectly. And so if you're going to receive more cash value early, that's got to come from somewhere, because again, all of these companies have the same mortality data. They have essentially the same investment portfolio. Like there's a little bit of variations, and that's why some are performing better than others, but there's mandates to what they can invest in. And so when we look at the long-term cash value, you can see the differential is pretty huge. And so if we just take, say, the year 3 cash value, where you put in 150,000 in Lafayette, you have 147, and with Penn Mutual you only have 138. They actually have the least. If you look at Mass and Guardian and New York Life, Penn Mutual has the least cash value. But what I ask people is, look, if you're doing real estate or you are using this for other investments, is that delta, the missing, call it 9,000, is that going to make or break your investment plans? And the answer is usually no. And if it does, maybe you just want to consider a slightly smaller policy. And is giving up that, call it $9,000 in year 3, and it's really just access, is that worth, say, having an extra, I don't know, I guess would be $500,000 by age 77? Like in age 77, this is where at this point you're probably not doing infinite banking, like taking loans and paying them back. You're probably just reverse engineering the policy and taking tax exempt loans, and having an extra $500,000 does actually make a difference. If we go over to the death benefit column, and I realize a lot of people say to me like, the death benefit doesn't matter to me. All I care about is the cash value. But what they don't understand is that with whole life, the cash value has to equal the death benefit by life expectancy. And so if your death benefit is shrunk wrap, like you see with Lafayette Life and Mass Mutual in the early years, so that you have more early cash value. Those are the 2 companies that have the most early cash value over on the left early on. But you're paying for it because your cash value isn't on this guaranteed trajectory to equal the higher death benefit. And so the fact that the Penn Mutual is pulling it up, and at least the Mass Mutual is keeping pace somewhat just due to their underlying performance, that at least helps the cause. But don't discount the death benefit, especially the fact that, like, if we look all the way out to, say, the last 2 lines, the 80, 87, and 92, when you're taking loans from an infinite banking policy, you're technically borrowing against the death benefit, right? They're just holding your cash value as collateral. So that's all they'll let you borrow. But when you have this death benefit that's over and above the cash value, that allows you to spend extra money while you're alive, like, say, cancerous assets like 401ks or IRAs that aren't necessarily great assets to transfer. And you can learn more about that in my retirement article, Using Whole Life for Retirement, at bankingtruths.com/retirement. You can learn more about that. Let's just look at the 37, that first year cash value, because a lot of people tend to disqualify themselves as they get older. But we look at 41,708, 45,464, we're talking like an extra or $1,000 less. Like if we just jump from age 37 to 47, people think that their policy is going to be so much worse and that they want to do everything on their younger spouse or their kids because it's going to be so much better. But what, again, going back to the ratios that I talked about at the beginning of this video, what they don't realize is their cash value actually keeps pace because they get to shrink wrap less death benefit around their cash. And so if you look at the death benefit numbers, you remember with the 37-year-old, we'll just look at it again, you know, the Penn Mutual was at 7 figures, the Guardian and the New York Life were at 7 figures, the Lafayette and the Mass were at $750,000. Well, now everything's shrunk down a little bit more. And so because of that, the cash value doesn't suffer. And we can see the same pattern, that Lafayette's ahead for the first 7 years. I think with the 37, again, they were ahead for the first 7 years. And after that, the Penn pulls ahead, the Mass Mutual is right behind, and the Guardian and the New York Life are following along there. But we see kind of the same pattern. For the 47-year-old, this is the 47, and the 57-year-old. Penn actually pulls ahead at that 7th year instead of the 8th year here. But same pattern that we're seeing across all of these. And so go ahead and pause, study it. But if you want to see your own numbers, I strongly suggest book a call with one of our experts. We're happy to shop your situation. You're happy to model your own numbers, because maybe 50,000 isn't your cash flow. Or you want to see, is it better on you or your spouse? Is it better on your kids? How to blend the family money. And those are the types of things we do, is really help to optimize according to the body, which we can. We like diversifying between different companies so that you actually have a portfolio of insurance, but there is a certain way to optimize different companies on the different bodies if you're going to do it for every family member. So when you look at the 57-year-old, if you're this old, you don't need to be disqualifying yourself. Things still work out, and they work out well, and you have enough time to compound to use this as your own bank. However, if you are 47 or 37, more and sooner is better. That's another thing you hear me say in my videos. Put in more, get more and sooner is better. Not only because you get to lock in that pricing for the guaranteed cash value, but for all of your future PUAs as well. They're all going to be slightly more efficient. And a lot of people don't realize this, but PUAs, these paid up additions, and if you don't know about that, you can go to bankingtruths.com/PUA to learn more about it. They're the whole life's turbocharger. They really mimic or mirror the base policy. And so base is important. There's another myth out there. It's known as the 1090 policy. And in fact, if you go to bankingtruths.com/1090, you can watch a video strictly on this study. But I'm going to put the ratios up here with the 47-year-old. The Guardian policy is exactly a 1090 policy. And they're the only carrier that allows you to do that. What that means is, in this case, you're putting $50,000 a premium. Only 10% of your premium goes towards base, and 90 gets to go to PUAs. Now, some of that will get eroded by the term rider that allows you to stuff in more. That's your your titanium chassis. It allows you to stack more PUAs. But it seems amazing. This 1090 thing seems great, but it's a myth, right? Because if we look at the Lafayette, that's 1189. Well, obviously it's beating Guardian early. Penn Mutual is 1387. Only 13% of your premium goes to base and the rest goes to PUAs. But what the disparity is showing, you would think the Guardian would just be winning, crushing the whole time, and they're not in any of these time frames. And it has to do with quality. The quality of the underlying policy, the base policy, and the PUAs matters more than the quantity, the proportions. My analogy is just like a good meal. If you're going to have a good meal, yes, the quantity does matter to some degree, but if all things are pretty close, 1090, 1387, the Mass and the New York Life, the reason they're so high is these are either a 10-pay policy underneath, so that more of your base is actually going to overfunding, so to speak. So with my restaurant analogy or food analogy, the quality, the nutrient quantity of the underlying policy actually matters more than the proportions, as long as they're kind of within a range. And again, you can see that here. The other thing I want to address, another myth that people hear about, is Lafayette Life has a dump-in rider it's a single premium paid up additions rider that if you have a savings account, you can just wholesale dump that in without turning it into a MEC. Well, more and sooner is better. However, there's a trade-off. You actually have to add more death benefit, whether it be from base policy or term rider, in order to do this. And so if you go to bankingtruths.com/dump, you can see that we dispel this myth. You're better off getting a more efficient policy and staggering that dump in over 3 to 4 years, rather than dumping it into a policy that is already kind of suffering from poor quality, especially long-term performance. All right, and last, what we did this year that we haven't done in other years is we included a heavy borrowing scenario. So this is the 47-year-old with the same 7 premiums of $50,000, but then just incrementally bigger loans, $65,000, then $100,000, then $200,000, then another $200,000, then $400,000, and then just straight retirement loans from age 67 on of $42,000. Now, I realize most of you won't borrow to this degree, but it's good to know to see what happens using the native policy loan. Now, I know some of you have heard that you must have non-direct recognition. You have to have non-direct. You can't have direct. And I can tell you this is another myth. This is complete and utter nonsense. Using my car analogy, it'd be like, you know those cars like the lowered Honda Civics or the Toyota Corollas with like the big muffler that sounds like the car ran over the whoopee cushion? Well, the loan type is like the exhaust thing. It'd be like somebody's telling you, no, you don't want the muscle car. No, you don't want the Tesla. No, you don't want the Porsche. You want one of these things. This is super important. You have to have it. Like, give me a break. And if we go back to the analysis, you can see if we scroll down that some of these cars aren't even finishing the race. They're just straight up breaking down. This is equalized. Again, going back to the myth of non-direct versus direct recognition, the highest early cash policy in Lafayette, you can see now has a 7% loan rate. And if there's no effect, non-direct, it means there's no effect to your policy. They're not going to subsidize your dividend with this higher loan rate that's now disconnected from the lackluster long-term policy growth. So those agents that told you get this policy, it's all about the philosophy, it doesn't matter, you are getting hammered now. If you have one of these policies, I strongly suggest you take a look at your options. You can go to bankingtruths.com/schedule and we can help model out some options for you. And if you want to learn more about the myth of direct versus non-direct recognition, go to bankingtruths.com/direct. There's an article and a video. The video is update and we compare these companies, but we also show what happens if interest rates get even higher. Like what happens to these two cars that finish the race, the Penn Mutual and the Mass Mutual. You can see Mass needs a little more fuel. Those red numbers mean that premiums come back in. And you might think, oh, well, I'll be dead by my 90s. Maybe you will, maybe you won't. Maybe there'll be some advances in AI. And part of the reason why Penn Mutual is preserved is not only the direct recognition is like a backstop, it actually starts to subsidize your dividend if rates get too high. There's also an overloan protection rider. It's a special rider only Penn Mutual has. I don't understand why these other companies don't institute it. IUL companies have them. And what it means is you can borrow up to 99% of your cash value. And they may freeze you. That's why you don't get 42,000 at age 89. You only get 37. They'll freeze your cash value, but they'll also freeze an amount of death benefit that you can't, that contractually won't blow up. Again, the guarantees of whole life. They're not going to let it blow up because these other cars that didn't finish the race, not only did you lose your cash value, your policy, your death benefit, but you also now have a tax bill. If you took out, which here you did, you took out a lot more than you put in, then you're going to actually owe taxes in that year at a concentrated rate when your policy blows up and they send a 1099 to the IRS, which would suck. You don't want that. Anyway, I hope you enjoyed that. Oh, one more thing. I own 3 out of 4 of these companies. Thankfully, I did not get any Lafayette policy. It was not wooed by that early cash value. And there was a little bit of like, it's giving Ohio National, as my kids would say. But I didn't, I do have Penn, Guardian, which are both direct recognition, and Mass, which is traditionally non-direct, but actually people don't realize this. Mass lets you choose at the onset of the policy if you want direct versus non. And I actually chose, like I can do whatever I want. I chose direct recognition because I knew I wanted to lock in my cost to borrow, even if I had to go get my alpha on the outside with my infinite banking strategy. And I'm so happy I did. Everybody told me I was crazy. I feel vindicated now, but that ought to tell you something. So again, check out that analysis and you can see what happens when interest rates go up to non-direct recognition policies. And last, if you haven't seen our video comparing the old 1980s policy to high yield savings, what you're realizing is these numbers that we're looking at, the 37, 47, 57-year-old, they're all pretty low. Like, I know they're talking about lowering rates, but now they're saying inflation's out of the bag. The Fed is going to have to keep ping-ponging rates between protecting for recession, but also inflation is out of the bag. And so the bankingtruths.com/savings video will show you what happens during the 80s with an old policy, and the dividends turned out to be so much more, like so much more, not only like 100%, like 150% more than what you're seeing. That means like 2.5x. And so like you're actually at the opportunity where you can maybe lock in your right to those future dividends. If you have any questions on any of this, you've stayed this long to the video, I commend you. Email me. hutch@bankingtruths.com. I do my best to get through serious inquiries and questions that people have, and I'm pretty active on emails still. I know that's kind of boomer. And if you want to see any of this stuff modeled out for you, your family members, try to figure out what we talked about, how best to optimize a family policy, which bodies with which company, go to bankingtruths.com/schedule, and you can go ahead and book yourself an appointment there, a Zoom call. Anyway, I hope this helped, and we'll talk to you soon.